Uncle Kevin here. I'm here to help you make smart money and personal finance decisions. Today we have a guest, Amika Pillay. She's from Coronation. She's investment specialist for retail business. And she's been my Coronation go-to person consultant for many years. I'm very glad to have her with us today to talk more about Coronation. Maybe you know about Coronation. Coronation Fund Manager is one of the largest fund managers in the country, and it has been doing well in terms of delivering performance for investors, young and old. So Amika, thanks very much for the opportunity and your time to join us on this program. And can you tell us more about, first of all, yourself, where you have your journey with Coronation?
Sure. Thank you, Kevin. It's a pleasure to be invited. So I joined Coronation at the end of 2013. So I've been with the business for just under 8 years. Prior to that, I was at another asset management business, and I started my career off at Daberistic, actually, straight out of university. So I spent about 5 years at Daberistic before moving on to the asset management industry.
Now that we actually celebrate Women's Month this month, and so it's good to see someone like you who has been in the financial service industry, and I think it's good that a lot of women are doing a great job in the financial service sector and leading the way. Can you tell us about Coronation Fund Managers? Who is Coronation? How did it all start?
Sure. So Coronation Fund Managers effectively is an investment business. We are an asset management business, and we manage money on behalf of South African investors. We are basically custodians of clients' savings. Clients entrust us with their capital to invest on their behalf. The business was founded in Cape Town in 1993 by a group of investment professionals who had left a previous established institution to start what they wanted to be a dedicated fund management business. We started off with 0 assets and 0 clients, and their objective was to build a world-class investment-led independent fund manager. So a lot of focus on the word independent, meaning that we didn't want to be owned or have any major shareholder, either a life company or anything like that. We wanted to maintain our independence in the market. And almost 28 years later, we are a leading brand in the South African investment industry. And we currently have assets under management of around 630 billion rand.
That's amazing. So what makes Coronation stand out different from its competitors?
Yeah, look, I think I would focus on 2 key differentiators here. First would definitely be that at Coronation, we have quite a unique culture. And that culture is central to everything that we do. Our culture is shaped by 6 values. First being ownership. So 25% of our business is owned by employees. And we are encouraged to think like owners, not like employees. And I think that on its own creates quite a different mindset because we are all encouraged to think about our roles as running our own business. The second is putting clients first. So obviously being custodians of clients' capital, every decision that we make is with the end client in mind. Long-term thinking. Now, long-term thinking is it's central to our investment philosophy. It's a key tenet of our investment philosophy that we think long-term in terms of the decisions that we make, because, we want to be around for a long, long time. And we believe that investing is a multi-decade journey. So one has to focus on the long term. And that key, value is central to everything that we do, even on the investment side. We take a team-based approach. So, we foster a team culture very strongly in the business. The next value is acting with integrity. So, of course, it sounds quite simple, but again, in every decision, in every responsibility that we shoulder, we make sure that we act with integrity. And the last one being a strong performance culture. Now, of course, it is an asset management business. Our aim at the end of the day is to deliver good performance to our clients. We strive to deliver outperformance over our benchmarks over meaningful periods, and we would consider anything longer than 5 years to be meaningful. So we are driven by that culture of strong performance. The second differentiator, and I think that's one that's quite key because we are an investment-led business, is that Coronation has one of the most stable and experienced investment teams in South Africa. Our investment team is made up of over 50 investment professionals, and we are one of the only investment teams in the world with 3 former chief investment officers who are still actively managing money, 2 of whom are actually founding members. So to still have founding members within our business still managing money helps to cement the culture of the business as well, because the culture is often driven from the top down. And whilst we do have a flat structure in Coronation, it is very important to still retain that old blood to try and foster a culture that is so central to everything that we do.
I really like what you mentioned about the values, and also that the business owner thinking, and also that the culture at Coronation, because it sounds like a very stable team and with a good culture that actually pull everyone together. And that my journey with investment shows that experience is very important. If you have someone who's been around, who has been the ups and downs of the market through the crashes, and then they know how to deal with certain situations and not panic. And I think that's really important. So
absolutely.
Coronation has quite a wide range of funds. Can you unpack it for us?
Sure. So yes, Coronation does have a wide array of funds that we offer to the retail market. But what we've done is we've identified what we call a flagship range of funds, both domestically and abroad. And the bulk of the assets that we manage actually are invested in that flagship range of funds. And the reason for that is because we've picked those funds in particular because we believe that they cater for the bulk of financial planning needs. So we have a local range and an offshore range. And the local range consists of 5 funds. So we have a cash alternative, which is designed to provide immediate income. We have 2 multi-asset funds, one low equity and medium equity fund that caters for income generation and capital growth. And we have 2 long-term growth funds. One is a balanced portfolio designed to create wealth for clients in the build-up to retirement. And then there's the 100% pure equity fund, which is also designed for the wealth accumulation phase. So to give you an idea of what that fund range looks like, I'm going to put up a slide to demonstrate that, and to give you a picture of what those portfolios look like. So you can see in a sort of illustration. So this is our domestic flagship range of funds. Can you see the screen, Kevin?
Yes, I can see your screen.
This is an illustration of what the domestic range is. So you can see on the extreme left-hand side of the chart, we've got the investment objective. So that is what the investor need is. And you can see it's split into immediate income and growth, and then long-term growth. And this is put on a risk return axis. So the fund at the low end of the illustration is the lowest risk portfolio, and it goes all the way up to the highest risk portfolio. And as I mentioned, we have the Coronation Strategic Income Fund, which is typically a very conservative portfolio. It doesn't have equity in it. It is a flexible fixed income fund that is trying to deliver an outcome that beats money market by 2%. And so that's the requirement that it fulfills. One notch up from that is the Coronation Balanced Defensive Fund. So this is a low equity portfolio that is designed to beat inflation by 3% over the medium term, but also preserve capital and provide some income in retirement. Next up is the Coronation Capital Plus Fund. So this is a medium equity portfolio designed to meet a CPI plus 4 objective. So also, this portfolio has been designed for the first half of retirement, where clients want to, not have too high an exposure to risk assets, but have sufficient exposure to generate those inflation-beating returns, whilst also being able to derive an income from the portfolio. The last bucket of funds on the domestic range are our two long-term growth funds. So we have the Coronation Balance Plus Fund, which, as I said, is the ideal portfolio when you are saving within the retirement structure up until the point that you do retire. It's a high equity portfolio. It doesn't focus specifically on capital preservation or income generation. It is designed for long-term growth. And then finally, the Coronation Top 20 Fund, which is a 100% equity portfolio. It's SA equity only. So obviously, the risk portfolio in the fund range geared for long-term growth. All of these funds, with the exception of the Top 20 Fund, are Regulation 28 compliant. So they have been built and designed to cater for the need of a client who is investing in retirement. So that's the domestic flagship range of funds. And then what we did is we replicated that flagship range on the offshore side. So the look and feel of the fund range is very familiar, and clients can get a lot of comfort around the fact that the global range is a replica of the domestic range. So again, on a risk return axis, we've highlighted the investor need being income, preservation, long-term growth, and these are the funds that sit in this range. So right at the bottom of the slide, you'll see the Global Strategic Income Fund. So again, this is a flexible income fund that is designed to give you an enhancement over cash or money in the bank. Then we have the current Global Capital Plus Fund, which is a conservative, low equity fund that has exposure to the various asset classes, also designed to preserve capital over time. And we have Global Managed and Optimum Growth. Now, these are two multi-asset funds. Global Managed Fund is a typical balanced fund, which gives you exposure to equities, bonds, property, and cash in the global space. And Optimum Growth, which is actually a new introduction to the portfolio range. The fund was launched just in May this year. Optimum Growth is a fully flexible mandate and can invest in any asset class, in any geography in the world. So it is completely unconstrained and geared for long-term growth. On the pure equity side, we have two funds. One is the Coronation Global Emerging Markets Fund, and the other is a Coronation Global Equity Select Fund. The Emerging Markets Fund, as the name suggests, is a pure emerging markets portfolio, giving clients exposure to what we perceive to be the best equity ideas in the emerging markets universe. And the Global Equity Select Fund is a more developed market biased fund, but will have some exposure to emerging markets if the portfolio managers deem fit. But the Global Equity Select Fund is our flagship, broad, more general equity portfolio that we run at Coronation. So that, in a nutshell, is the flagship range of funds. Of course, outside of this, we do have other portfolios. We have sector-specific funds like a property fund, an industrials fund, a resources fund, a bond fund. We do have those funds available. All of that information is available on our website. But like I said, we've filtered that down and tried to simplify the fund range for the end investor because we think sometimes it can be quite overwhelming in terms of trying to decide which is the most appropriate fund when you have a long list of funds available.
Okay, thanks, Amika, for unpacking your fund range for us. I think even though you say it's in a nutshell, but with those two slides, it's a lot of information, a lot of funds. I noticed in those slides that you have numbers next to each fund. What does it mean? Can you just also explain that to us?
So the white numbers next to each fund are the 10-year return statistics, and the blue numbers on the other side of the fund names are your risk statistics. So it is a measure of the standard deviation, which is risk used in the investment world, 10-year period. So that's what those numbers are.
Okay. So Amika, I just want to maybe just treat me as a first-time investor. All right. So for someone who look at these charts and the fund range, can we say that maybe for someone who want to invest, maybe get some better return than just money in the bank, but don't want to take risk, maybe want to have a quick access to money at any time, then maybe
Yes.
Coronation Strategic Income Fund can be suitable.
Yes. So the Strategic Income Fund, as I said, is a fund that is designed to give you money market plus 2 in a sort of best case scenario, without taking on excessive risk. As I said, the fund is not allowed equity, and we are capped at 10% on the property side. So property is classified as a risk asset. So it is quite a conservative portfolio. And I think in that time horizon, one would gravitate towards something like the Strategic Income Fund, bearing in mind that an investor should be in the fund for at least 1 year. So if your time horizon is less than 1 year, and you do require the capital in a shorter time period, I don't think that the fund is necessarily appropriate. So in order to get the benefit of the cash plus 2, the market plus 2, you should be invested in the fund for a period of 12 months or longer. Remember that anytime a fund is able to deliver an enhancement over cash, there is some element of risk that is taken in the portfolio. So it is a conservative fund. One needs to be invested for an appropriate time period, which is 12 months or longer.
Right. Other extreme is that, let's take example, my son who's 18 years old, he's young and he just want to, hopefully that he can retire by age 50. And so he wants to invest aggressively. He wants to get the best return possible. Then perhaps he should choose like a Coronation top 20 and invest that for long term, because from what it's presented here, it's probably give you the best chance to generate the best return over the long term. Is that right?
Absolutely. So typically in investments, the higher or the more risk you take, the better your return should be. And over any extended period of time, and if you're looking at a time horizon of the next couple of decades, equities have always proven to be the best performing asset class and the best asset class at generating significant inflation beating returns and creating wealth. The top 20 fund, as the name suggests, gives clients exposure to our best 20 ideas available on the market. So it is a high conviction portfolio giving you what Coronation believes to be the best 20 equity picks from the universe of the entire market. So absolutely, for a young investor wanting to put money away, has the risk appetite and the time horizon, the top 20 fund would probably be the perfect solution to meet those long-term needs.
My next point or question is that what's Coronation's expectation of returns from various asset classes at the moment?
Sure. So we usually, publish an expectation of what we think markets can deliver over the next 10 years. And again, the reason why we do it over a 10-year period, like I said, we are long-term thinking in nature. We think that in the short term, anything can happen in markets. Once you extend your time horizon to a 10-year period, the ability to forecast becomes a lot better. And also, in the investment game, one has to have a long-term focus because, like I said, investing is a multi-decade journey. It's not something that you're trying to do for just the next year or two. That being said, I'm going to put up another slide, which we've been publishing for a number of years. And what it does is it breaks down each asset class and it shows you what our expected range of outcomes is for that asset class for the next decade. Now, it is a band of expected returns because, to hang your hat on one particular number is quite difficult. It is a forecast. So we provide a band of expected returns within each asset class. And this is what we think the underlying markets can deliver. So it is based on assessment of what we think the equity market, the bond market, the property market, et cetera, can deliver on average over the next 10 years. Obviously, as an active manager trying to outperform the market, we should be able to add what we call alpha. Alpha is the outperformance over and above the market. we should be able to add additional performance on top of that. So it looks like a little bit of a busy slide, but I'm going to talk you through it. So the purple blocks represents our expected range for each asset class. At the bottom of the slide, you'll see each asset class listed: local equity, global equity, local property, local bonds, global bonds, and cash. Right? So these are typically the asset classes that one uses to construct a portfolio. And we've got the inflation forecast range highlighted here. So South African inflation expected to be between 5 to 6% over the next decade. The red dots show you what the last 10 years returns have been. So what we also try to get investors to see here is where we've come from in the last 10 years and what we think the future is going to hold over the next 10 years. For some asset classes, we've got quite a wide band, like property, and that is to acknowledge the uncertainty within that particular market or asset class. So if there's a lot of uncertainty, we widen the band to cater for the possibility that our forecasts may not come to fruition, or that there may be risks to that forecast. So to jump into it, on the local equity side, we think the SA equity market can deliver anywhere between 8 to 11% on average. So I talked about alpha, and alpha is key to everything that we do. It's all we're trying to do is outperform our markets or the benchmarks for our clients. And we would typically look to add 2 to 3% on top of what markets can deliver. So that's over a 10-year period, that is what we would look to add. And then on the global equity side, these are RAND forecasts. So you can see a very muted expectation of what global equities can deliver over the next 10 years. When you contrast that with what global equities have delivered over the last 10 years. So global markets have compounded at north of 18% per annum for the last 10 years. And we don't think that that is sustainable over the next 10 years. And we are expecting global markets or global equity markets to deliver a much more muted return over the next decade. So markets move in cycles, especially equity markets. They don't move up in a nice straight line. And equity markets, having done so well, we question the sustainability of that. And that is why our expected return forecasts are much lower than what we've come to experience over the last 10 years. On the local property side, you can see that our band is between 6 and 12% over the next 10 years. And again, quite a wide band of expectation. And this is because we believe there's a lot of uncertainty in the listed property market at the moment with the advent of COVID, lockdowns, work from home. All of these things have left us in a situation where we don't know what the future for listed property is going to look like, even after COVID has come and gone. We think that demand is going to be much lower. And while work from home is not going to be a permanent feature, it will take a long time for this to work through the system. On the retail side, for example, we have got lots of shopping centers. Online shopping has taken off in a big way. So again, not quite sure what the future is going to look like and whether online shopping continues to take market share from a South African perspective. Yeah. So we have a situation where demand and supply is out of balance. It doesn't bode well for the prospects of listed property. On the local bond side, again, quite a wide range of outcomes, 6 to 10% band. And that is to cater for any possibility of government defaulting on their debt. So one of the huge concerns we have in the bond market is how much debt sits on the balance sheets of government. The fact that we have been accumulating debt at a very alarming rate, and we pay a very high interest to service that debt. And when interest service costs are escalating at a pace that exceeds economic growth, for example, it becomes a very unsustainable situation. And in that situation, if government does default on their debt, it means you would go from an expected return of 9 or 10% to something much lower if, as a bond you have to take a haircut on your debt, which is the most likely scenario in the event of a default. So we're trying to cater for that possibility and build it into our expectations, which is why we say the expected return from that asset class can be anywhere ranging from 6 to 10 on average over the next 10 years. On the global bond side, you can see the range of outcomes sitting between 3 to 4%. So this is an asset class that we are not excited about. We do not like the asset class in the context of portfolio construction because interest rates globally are at all-time low levels. And there's an inverse relationship between yields and prices. So if yields do pick up, because interest rates pick up globally, you lose capital. And given where we are from a global interest rate perspective, the next step or the next direction will be upwards, in which case investors stand to lose quite a bit of money in the global bond space. And this is not an asset class that we think is going to deliver inflation-beating returns over the next 10 years. And then finally, on the cash side, our expectation is for cash rates to average between 5 to 7%, which you can see is very much in line with our inflation forecast. So cash rates at the moment are at a multi-decade low because our government has stepped in and had to provide support because of COVID. And if inflation is going to average around the 5 to 6% level, and cash is going to give you a similar interest rate or return, you can see that cash as an asset class is just not going to give you inflation-beating returns. So your sort of primary target when you are investing is to beat inflation, so you can preserve the purchasing power of your capital. And for us, cash as an asset class is not going to be able to do that. And as a result, it's not an asset class that we have big exposure to within our portfolios.
Thanks, Amika. I have three points to make or questions.
Sure.
The first one is that to me, it's a bit surprising to see that your expectation of local equities is going to be better than the global equities, given the fact that South Africa has gone through so many problems. We still experiencing the frequent load shedding. Last month, we had the riots that took place in Durban and Joburg, and we are still recovering from that. And I think generally that people are more pessimistic about South Africa and its outlook, whereas like globally, there are so many countries and opportunities out there, industry that don't exist in South Africa we can invest in. So just my observation, I found this intriguing that your expectation of local equity is actually going forward better than global equities.
Global, yeah.
Then the other point is about when I look at what you present just now with this chart, is actually reminds me about the mistake I made back over 20 years ago when I first made my investment into unit trust. At that time, I bought into BOE Equity Fund and the Sage Financial Services Fund. At that time, I didn't know much about investment, even though I did my actual studies. And what I did was I just pick up a newspaper on Saturday and they say, okay, which are the funds that done the best over the last 5 years? And surely they are the best fund managers because they have done so well over the last 5 years. So I can just put money into these two funds and expect them to do well in the next 5 years. And how wrong was I? And it was a painful lesson I learned. So I think it's very important for anyone who watched this episode to recognize that the past performance is not indicative of future performance. And we always need to, with investment, looking forward and not looking at the rearview mirror and say what has done well in the past is going to continue to do well in the future. So that's important lesson for anyone. And the other thing I found interesting to pick up is that you didn't put any forecast for global property. Don't you think global property is an important sector that is not something that Coronation keep tracks of in your analysis?
Yeah. So one of the reasons why we didn't include global property in that forecast is that property doesn't form part of our benchmark for any of our portfolios, right. And we don't do a global property fund. So we do individual stock picking based on opportunities and ideas that we find around the market. but it is based on research. But if you look at the benchmarks for the global multi-asset portfolios, property does not feature in terms of the benchmark. It's an equity bond benchmark in that multi-asset space.
Does that mean that your offshore fund is not going to invest in REITs at all?
So no, we do have property exposure, but like I said, we will do the research and identify individual opportunities where we see fit. But it is technically an off-benchmark asset class to include in a fund like Global Manage. The benchmark is 60 equity, 40 bond. We will own property because it is a multi-asset portfolio that is trying to give you the best possible return by sourcing the opportunities across all asset classes. So we have had as high as 10% property in our Global Managed Fund. Today, it's a lot lower. But those opportunities we will find as and when they come up, and it's something that we actively look at. But because it's not part of the underlying benchmark, we haven't put a forecast on global property as an asset class.
There's a viewer that asked me this question: what is unit trust? Can you just explain to the viewers what is unit trust? How does it work?
Yeah. So look, a unit trust is a pooled investment. It's a collective investment whereby investors are able to access or purchase units in that pooled or collected investment portfolio. So you don't buy the underlying shares necessarily. You buy units in a fund that is run and thereby giving you exposure to those underlying asset classes or investments. So if you buy an equity fund, you're not necessarily buying the shares in your own capacity. You are looking at a pooled or collected investment vehicle, and you are participating by purchasing units in that portfolio. So to give you an example, if you were to buy equities in your own capacity versus buying equities in a unit trust, one of the big benefits from it is tax. So when you buy shares in a share portfolio in your own name, every time you buy and sell a share, you are liable for CGT, for capital gains tax, right? Okay. When the fund manager buys and sells shares on your behalf within a unit trust, there's no capital gains tax that's applicable for the underlying investor. It's only if you sell the entire unit trust that you are then liable for capital gains tax. So it is a wrapped investment vehicle that gives the investors exposure to the underlying asset classes and investment opportunities, probably in a more tax efficient way than if they had to buy the individual instruments in their own capacity.
The follow-up question to that is, how can I know that money with the fund manager is safe? The fund manager is not just going to run away with my money.
So look, at the end of the day, as custodians of capital, we are regulated and we are held to account from regulation and different industry bodies. And because we don't lock these investments up, there's no lockup, there's liquidity and clients can access their capital immediately. So all you would have to do is put in a redemption request, and we have to commit to paying out that capital by law to the end investor. So I suppose the risks are quite low, but it goes back to your point about investing with reputable managers and managers that have been around. They tried, they tested, their reputation precedes them, and it really boils down to trust. So our company slogan is "Trust is earned," and it really because if you have proven to be a worthy manager of money, then clients feel a lot more comfortable to give you that responsibility. At the end of the day, safe feels like a dangerous word because investing often doesn't feel safe because markets are volatile and the capital value of your money moves up and down over time. In terms of whether the asset manager is going to run away with your money or not, regulation and the laws that govern the investment industry prevent that kind of thing from happening. But I suppose safeguard yourself, again, you would go with a reputable asset manager, one that's got track record, and scale is also very important in this industry.
Great, thank you. Amika, the final question I have is that where does Coronation see opportunities at the moment?
Okay, so look, your first observation when I showed you the expected return slide would probably answer that our forecast for SA equities over the next 10 years is higher than it is for global markets or global equities. The reason for that is because when it comes to investing, particularly in equities, it's all about price. So, if you can buy a share that is very attractively valued and it's very cheap, good quality businesses with good potential to grow, that investment will make you lots of money. But when you buy something that's really expensive and it's already done, the probability of continuing to make money out of that asset is very limited, right? Yeah. So in investments, it's all about price. So you heard the old adage, buy low, sell high, and that is exactly what asset managers and fund managers are trying to do in their portfolios. You also mentioned that South African equity markets have underperformed for a number of years, and that is true. But that in itself is the reason why we are more optimistic about the future prospects for SA equities. It's because SA equities have underperformed and the prices are cheap, particularly last year when we had the big blowout in markets during the COVID crisis. We had the opportunity to pick up some of the South Africa's best quality shares at a fraction of what they're worth. And that sets you up for good future returns. So within SA equities, we think that asset class is set and geared to deliver very comfortable double-digit growth over the next 5 years. I want to add a caveat to that because of what you also spoke about. You mentioned your concerns over the South African sort of macroeconomic environment with load shedding, high unemployment, and all of those things. And those are very real concerns that we share. But when you look at the SA equity opportunity set and what sits in there, roughly two-thirds of the SA equity that we own are actually global businesses. So we have a unique opportunity in South Africa where our SA equity market is actually not reflective of the SA economy. And the reason for that is because we have exposure to companies like Naspers and British American Tobacco and Anheuser-Busch, Richemont, Bidcorp, Quilter. These are all companies that are listed on the JSE, but they're actually global businesses and in most instances have nothing to do with South Africa. But they make up a part of the JSE. They're attractive in their own right. They give clients much needed diversification. They're cheap. They offer good dividends in a lot of instances. And we have exposure to those stocks in our portfolio. So within an SA equity portfolio within Coro, we see value across 3 different buckets, right? The first bucket is that global bucket that I talked about, and some of the names that I mentioned are in our portfolio. The second bucket is the resources bucket. And even within resources and commodities, a lot of those businesses have diversified away from South Africa. They are what we call dual listed. So they're listed in South Africa, but they also have a listing elsewhere in the world, be it London or somewhere in Europe. So companies like Anglo American and Exxaro and Glencore, these are diversified mining companies, and a lot of their earnings comes from outside of South Africa. So even within our mining sector, we have offshore exposure, and we're finding a lot of value within that sector at the moment. As the world emerges from COVID and the global recovery takes place, we think that would bode well for demand for commodities which we produce. And there are other long-term trends like decarbonization. Everyone's talking about reducing your carbon footprint, but that also will mean good demand for other commodities like copper and cobalt, for example. There's a move to electric vehicles. Whilst it's a long way away, that trend would also bode well for maybe not platinum specifically, but other PGMs, palladium, rhodium, etc. So we think the environment over the next few years is still very conducive for resources, and we have a healthy allocation in our portfolio. And then the last bucket in our SA equities is what we call SA Inc. It's the pure domestic businesses that are reliant on the SA economy. And here one would argue that it is worthwhile to err on the side of caution. And so we have only 1/3 of our total SA equity carve-out sits in companies that are exposed to the SA economy. There are lots of companies that we would love to own. There's a lot of value there. We think stocks are incredibly cheap, but there's only so many spots available within a portfolio, right? So balance all of these sort of types of exposure within our portfolio, and we've got to decide which are the best opportunities for clients over the long term. But I think given concerns about the longer term structural issues in SA, clients can take some comfort from the fact that within a Coronation portfolio today, so something like Coronation Balance Plus, 2/3 of the SA equity building block is actually global businesses with a global earnings stream. So that gives you what we call Rand hedge protection. It's protection against any adverse outcome in South Africa because those companies earn their revenue from outside of South Africa. But we are finding exceptional value across all three buckets. So at Coronation, we talk about upside. So if you've ever heard a presentation from us, an upside is just the difference between current prices and what we think businesses are worth. And on average, our SA equity portfolios are offering upside today of north of 50%, which means the stocks in our portfolio are worth on average 50% more than where they're trading today. So I talked about how important this is, price being your biggest determinant of future returns. And today we think prices are exceptionally cheap on the SA equity market. So SA equities, we think, are a great opportunity for investors over the next few years. And like I said, you don't have to necessarily bank on a turnaround in the economy to do well out of SA equities today because we have that big Rand component to our market. I would say the second good opportunity sits within emerging markets. So we talked about how our expectation from global equities is a lot more muted. And it's for that same reason that prices are high in global markets today. Almost every single global equity index that you look at is trading at all-time highs. And that does not set the tone for great returns in the future. So we are expecting more muted returns. It doesn't mean there's no return available. We just think clients need to recalibrate their expectations. Because global markets have done so well in the last 10 years, it is unlikely for that kind of return to sustain itself. But as active managers, we back ourselves to do good stock picking and still deliver decent outcomes for clients. And one of the areas where we are finding very attractive opportunities is within the emerging market space. So we run one of the world's best emerging markets funds today with fantastic track record. And we identify what we perceive to be the best emerging market opportunities. Roughly 30% of the portfolio sits in China today. So we've got big exposure to China, but we've also got exposure to countries like South Korea, Taiwan, India, Russia, etc. Our emerging markets fund is also allowed to own developed market stocks, like a Heineken, for example, but those stocks have to get at least 40% of their revenue from emerging markets. So we classify as quasi-emerging markets. We are capped. We can't own more than 20% of our portfolio in those developed market stocks, but it does widen the opportunity set a little bit. So if you see a developed market listed stock in our emerging market portfolio, one shouldn't get confused. We are allowed to own those stocks, provided that at least 40% of their earnings comes from emerging markets. So we are quite excited. I talked about upside. The upside to fair value for our emerging markets portfolio is around 53% today. So very compelling. That's on offer within the emerging market space. And we think emerging markets should form a part of any client's global portfolio over the next decade.
You're like a living encyclopedia on investment. You can just keep talking about various investment stuff. And it's quite remarkable. What about Bitcoin and crypto? Can you or do you invest in cryptocurrency?
So we don't. It is not regulated. So that's the first stumbling block, is that it is not a regulated asset. And so we cannot invest it in our unit trusts. Our stance on cryptocurrency has always been that it's highly speculative. It is not money. The value of money does not change that drastically. And because of the volatility, it makes it exceptionally difficult to even include it in a portfolio. I mean, to invest in something that can be up 30% in one morning, but down 40% within a couple of hours, that's a high risk investment. At the end of the day, we are custodians of clients' capital, the bulk of which is retirement capital. This is money that clients have got to save and be responsible for their retirement. We cannot afford to take unnecessary risk and be reckless with clients' money. So as boring as traditional investments may sound, and the fact that you can get 10% over a 10-year period, that is often what clients need with retirement capital. And so because crypto is so highly volatile and unregulated, it is not for us for investing in our portfolios. Of course, if clients want to take, a little bit of a bet or have a bit of a gamble and they've got the money to do it, by all means, but we would equate it to gambling.
So
black or red kind of
you
thing.
don't agree with Elon Musk. Elon Musk is very much for crypto, and the likes of, I think, Robert Kiyosaki. He's also very much saying to people to invest in crypto, but then you don't, you're not in the same camp.
So look, we would never say don't invest in anything. Like I said, it's not an asset that we would include in our portfolios at this stage because it's not regulated, because you can't price it. So that's the other problem, is how do you price what this asset is worth, because it has no cash flow. So it doesn't fit in a traditional vanilla unit trust type of investment. But that's not to say that clients can't take a portion of their money and invest in it. But I suppose, like with any investment, you've got to understand the risks and you've got to understand what you're in for. And if you are comfortable with the exceptionally high volatility within that investment, then of course one can invest in it. The rewards have been tremendous, but a lot of people have a lot of money as well. So what often doesn't get sort of talked about is what people have lost. We hear the good stories about how much money people have made. So it is high risk. So it's something that one can consider. Like, we are strong advocates of diversification. So if you can have exposure to different asset classes over time, you will do well. But something like crypto, should never form a sort of significant part of your retirement capital, in our opinion.
Yeah. I found for myself that as I age, that I've become more and more conservative. Maybe I'll do that in my 20s, but right now, I'm very conservative.
Yeah, if it's discretionary money and money you can afford to lose, by all means. But when it comes to retirement capital, money that you have to live off when you are no longer earning an income, I think it is prudent to be a little bit more vanilla and to err on the side of caution a little bit.
Yeah. Amika, thanks so much for your time and for sharing the insights with us. Thank you very much for watching. Until next time. Bye.
Bye.
Thanks for watching. Thumbs up if you like this episode and share it with your friends.